Hi, welcome back to the next episode of entity choice or entity classification for tax concepts for deal professionals. The next topic is S-corporations. Again, I can't stress this enough. It's important to understand the type of entity that you're buying from a tax perspective. It can really drive the transaction, tax basis step-ups, no tax basis step-up, how to structure a transaction, so on and so forth. We covered C corporations or regular corporations in the prior episode. S corporations are effectively C corporations that make a special election to be taxed as an S corp. And so for legal purposes, they're still corporations and Inc., but for tax purposes, they're S corps. And what that means is for federal tax purposes, the income and loss of an S corp flows out to its shareholders. So unlike a C corp, in which it was the taxpayer, S corps do not pay taxes for federal tax purposes for the most part, and those taxes are borne by the shareholders of the S corporation. Some states do impose taxes at the S corp election, and that's something to consider. But the unique thing about S corporations are that one, there's a single layer of tax instead of a double layer of tax like you have at a C corp. But more importantly, there is an ability to get a tax basis step up if you buy an S corporation. If you're buying, more than 80% of the stock of an S corp in a taxable transaction, you have the ability to make what's called a 338H10 election, which effectively gets you a tax basis step up in the assets of the S corporation. And we'll talk about tax basis step ups in a later episode, but effectively a tax basis step up at a high level will get you additional depreciation and amortization deductions for tax purposes, which could be quite meaningful to your IRR. That's it for now. Be sure to check out our other videos on our website or our YouTube channel. We cover a lot of different topics for deal professionals that I think you'll find very interesting.